The following discussion and materials are to be used for informational and training purposes only. They are not intended to supplant the requirements of the Assessor's Reference Library, the Colorado Constitution and statutes, and relevant court case law. You should consult and rely upon appropriate legal authority.
Okay, I guess we'll go ahead and get started, you guys. So, welcome to Local Government Levies by DPT. My name is Thomas Young. I've been with the DPT just over 5 years. I have a couple of my colleagues here in the room. Laura Forbes and Lori DeCrow also work at the DPT. And Cynthia Thayer is here from the Division of Local Government. So today's class is going to be pretty short, about 3 hours. We'll take a few breaks, but everything that we're going to cover is in the outline that I emailed you. So you have copies of all of the slides, and you have handouts that we're going to look at as we go through the class. So the agenda that you all have, we're going to go through basically 3 large chunks of this class. The first piece, and it's probably the most basic, is what is the job of the assessor? We're going to talk about what the assessor does, how they do it, and why they do it in order to get the certification of values out to all of the entities. Then we're going to talk about what's actually on that certification of values, what affects the 5.5% limitation and the TABOR local growth limitation. We're going to talk about all the filing and legal requirements that are required on the entity's side in order to basically levy a mill and get money to fund operations. The last piece of the class is going to be Cynthia Thayer. She's going to give you guys an introduction to DOLA as a department and go through some of the budgeting law and budget requirements that everybody's going to have and follow. So I'm going to try to just stick with the PowerPoint being shared up on the screen. I have printed out the handouts, and so hopefully you guys can look at both of them as we need to switch between them. Can everybody hear me okay, though?
I can hear you fine.
Okay. So feel free to unmute yourself and ask a question if you need to stop me. Lori and Laura are going to be watching the chat box. And so you can go to the group chat and send a message to an individual person or to just the group as a whole if you want to get a message in. We'll try to get all of the questions answered. This meeting is being recorded, and we're going to put the meeting up on our website shortly after this is done. And it will hopefully be there as sort of a resource for all the local entities that have questions about how any of this works. And especially with some of the changes happening with the Gallagher Amendment and the residential assessment rate potentially dropping. A lot of people are paying attention to this and they want to just get a little bit up to speed. So feel free to share that information with anybody who asks. Okay. Okay, the overview of the assessment of the assessor's office. So the assessment function, those of us in the property tax world talk about the assessment function. The assessment function is the foundation of the assessor's office, and it essentially encompasses what a full year's worth of work is required by statute in order to make government function. To keep this civilization going, basically, the assessor's office, the the function is at its most basic level funding these operations that are necessary for us to all have this, to live where we live, to do what we do. It is centered around statutory deadlines. So there's probably 300 or more deadlines in statute that the legislature has written out to make sure that all of this happens on an annual basis. There's deadlines for every single thing, and I have a couple of slides in here that will actually give you some dates. But the whole thing is, so it's very date centered, and everything that we do is time sensitive, and it gets a little of a time crunch at the end of the year. Some of you might know, have experience with that, but it's all written in statute. That's the law that we have to follow. The goal or the spirit of the assessment function is to have fair and equitable values for all property, to ensure the integrity of the tax base. And when we talk about the tax base, we're talking about the values that the assessor has set, hopefully using good market data, that are reliable in terms of being able to levy some sort of tax against it and have that tax paid, and not have somebody be able to take it through the court system or somewhere else and doubt what those values might be. Ultimately, the goal is to produce the tax warrant and then to get the right tax bill to the right person. There's 4 main elements of this assessment function, and all of these elements compose of what the assessor's office does. So list and value are the first 2 that come to mind for most people. Listing includes all of the record keeping of ownership, legal descriptions, information on all the buildings and improvements, business, personal property, everything in the county. There's so many government offices, private companies that rely on this data that the assessor's office has to tell them who owns what piece of property, or how many parcels are in this county. So this list function is this giant record keeping, the assessment role of having all of this data. Value, assigning values at an assessment rate. So when we talk about value, we're talking about market value. That's what you'd expect a property to sell for on the open market. And assessment rates, having the right value times an assessment rate gives you the assessed value. And we'll talk a little bit more about that if you're unfamiliar with assessed values, in order to do the calculations. Discover is the third one. That means locating and identifying all of the property, discovering all of the land, all of the improvements, all of the businesses, all of the new constructions going up, houses being demolished, lots being split, or omitted property that wasn't picked up when it was actually due in the county. So the assessor's office is constantly working to discover everything that's in the county. That's their job. And then classify. We have a whole bunch of abstract codes that every property is classified into. So from residential to vacant land to mines, every property has to be classified because we have different assessment rates that apply to different properties. So it's important for the assessor's office to get the classification correct for residential properties because the assessment rate is so low. The advantage of having it compared to having that property classified incorrectly at a higher rate makes sure that everything is fair and equitable. Here are the two main calculations that we deal with at the most basic level for property taxes. Actual values, that includes the values of homes, of properties used for commercial or industrial, vacant land, ag land, and oil and gas, times an assessment rate. So for last year and this year, the assessment rate for residential properties was 7.15%. For non-residential properties, it's 29%. And for oil and gas, primary production, it's 87.5%. There's a few other assessment rates for some of the producing properties. That gets you your assessed values. That's the chunk that you guys get to levy against. And depending on whatever mill levy you certify, you take the assessed values times that levy to get the taxes owed. So a couple things about value. Actual value equals market value. So there's actually court case law to back us up on this. And the market value is what you'd expect it to sell for on a certain day. Again, your assessed value is your actual value times the assessment rate. That sales price, there's an appraisal date of June 30th of every even year. So as we go through this pandemic, people imagine the market value of my property should be way lower if they're a business and all the businesses are closing down, for example. But the market value is set as of June 30th, 2018. And so the assessor's office has to go back in time all the way to 2018 and ask what would this property have sold for on that date. So in markets like we might be experiencing now, it looks like it's sort of unfair or that it hurts the taxpayers because they're being taxed and levied on a value that's way higher than it currently is, especially when things are changing like they are with the COVID pandemic. But when it's the opposite way, you know, when we come out of this and the values start going back up, they'll get a market value as of June 30th of 2020, because that's the next even year. And that value might look really low compared to what that value will be in the future. So that market value, when we talk about the sales price, we have to remember it's always as of one specific date. The other important date to keep in mind, and I hope everybody's taking notes because there's a test at the end, you have to know all these things, is the assessment date. Okay. So on January 1, 12 noon, the assessor goes out and looks at every single property in the county, inventories all of the personal property for every business, and values it as it sits on that assessment date. The classification is also set as of this assessment date. So the biggest, not the biggest, one important thing for this assessment date is classifying residential property. And so the assessor's office is going to look around and see if somebody is living there on January 1st, if it is actually a residence, then it gets classified as a residential property for that year. Even if the use changes partway through the year, we look at what it was on January 1st. Okay. So after the assessor goes through and values all the property, goes through all of the appeals and everything is set, then the levies go out and the tax bills get paid, who gets the money? In Colorado, all the property tax revenue is used to fund local governments and school districts. So none of that property tax comes to the state of Colorado. None of it pays my salary. And that's been since 1964, the state hasn't levied a tax. It used to when Colorado was actually still a territory, it received most of its revenue through property taxes and funded a lot of the construction and infrastructure through property taxes levied on every property in the state. Now the state gets most of its money from sales tax and income taxes, and so the property taxes dropped off. And when we look at what all of that local property tax funds, these are the latest numbers that are available. So these are 2019 taxes collected at the beginning of this year in 2020. School districts get about half. So it's a pretty huge chunk of the money. County governments get about a quarter of it. It was 23% in the last year. Special districts, so that includes fire protection districts, pest control districts, all of those get about 20%. Cities and towns or municipalities get about 5%, and local college districts are 1%. So total taxes last year were $9.6 billion, which is an increase of $1.4 billion over the year before. And here it is a little bit bigger just so you can see. Obviously, the schools getting funded through property taxes is pretty big. The state government also fills in a lot of money for the school systems under the Public School Finance Act. And so that's where most of what we're concerned with property taxes is going. Okay. Any questions so far? Well, for the next chunk, certification of value. So what is certification of value form? This is what starts the process for determining an entity's mill levy based on the current year's property values and budget needs. The certification of values reports value and revenue information. It's sent to each local government, and there are more than 4,000 local governments currently in the state. And it's used to determine your revenue and spending limits and the revenue potential from property taxes, and to ultimately calculate the actual tax rate or mill levy. The assessor sends this out twice a year. The first one is on August 25th. So as we head into the end of August, that's when the assessor's office finally has all of the values solidified through the protest period and appeals with the CBOE. And we move into the fall where the entities have to budget for next year. The second certification of values form is sent on December 10th. And that is to capture any changes that might happen in the values between August 25th and December 10th, and get the best known number to those entities to calculate the correct revenue and spending limits. This year, those dates changed a little bit, and I have a little piece a little bit later about what dates have changed because of the COVID pandemic. But next year, it's going to be August 25th. All of these entities, local entities across the state, develop a budget every single year. And it's done in advance. So this time we're budgeting for calendar year 2021. Those budgets have to be reviewed and approved at public hearings. When I first started the DPT and I heard about this, I was very surprised because everybody always talks about being taxed out of their home, and they don't know, this tax money that they pay is just being spent on who knows what that they're not aware of. And even my own parents didn't know. I went and looked up what entities their house is covered by, and what mill levies they pay, and they didn't know what services that property received. So this public hearing and what those entities are going to be doing is something that I have tried to push as a good customer service, just good information to share with people, that they can go to these hearings and they can see the budget, they can see the numbers and see what is happening. What are these groups doing? Property taxes may fund all, part, or none of a budget. So obviously there are entities out there that get all of their revenue from their property tax levy. Some entities get none of it because they have other sources of income. The form lets you go through and calculate what that piece of revenue from the property taxes that's needed to calculate that. And ultimately, the mill levy is certified at a public hearing. So everybody can go have a chance to speak or hear what's happening. None of this is happening behind closed doors. It's not secretive. And the basic calculation for the mill levy is that you have a certification of values form comes to your entity, and the assessor's office has certified so much assessed value sits within that entity's boundaries. That assessed value times the mill levy of the entity equals its revenue. So to work backwards from that, if you know how much revenue you need and divide it by the assessed value that the assessor's office gives you, you can calculate your mill levy. Spending limits. So the reason that we go through all of this is we have two laws in place in Colorado that limit what an entity can spend. They have to sort of be under these limits that the people as a whole have either voted for or had their representatives write into the statute what they think the entities should be spending. The first one is TABOR. This is Article 10, Section 20 of the Constitution. So it's important. This TABOR limit is constitutional. That means all of this text was voted on by the people of Colorado to change the Constitution and put it in there. It's a lot harder to change the Constitution than it is to change statutes. And if you have handout 1 for constitutional limits, we'll look at some of the language. I'll have you guys actually look at it here in a second, because it defines everything that you need to know for going through that certification of values form and where to get these numbers and what the numbers mean. So the first thing that we're going to look at is fiscal year spending, fiscal year revenue, and local growth and inflation. The main premise or idea behind this limit in TABOR is that it says entities, you get the same amount of money that you had last year, plus local growth, whatever this local growth is, plus inflation. So depending on whatever those two factors end up being, that's what the language was written to limit the growth of local entities. That applies to property taxes and non-property tax revenue as well. And in order to exceed that limit, they have to go to the people and ask them, can we have more money than what is written in the Constitution? There was an op-ed by Dennis Gallagher in the Denver Post a few days ago. I don't know if anybody had a chance to read it or saw. With what's on the ballot, it's a repeal of the Gallagher Amendment. And he is vehemently opposed to it because he thinks that it protects residential property owners by limiting what that assessed value can be. But at the end of it, he really hammers home this point that if these entities want more money and they're certain that the people want that service and need that service, then they should just go to a vote and they'll have no problem getting it. That's not necessarily always the case, and it's often politicized or skewed one way or another when there's a vote for more money. But under TABOR, in order to exceed that limit, for whatever the entity might need, they have to ask the voters. Sorry, my cat is running around and knocks stuff over. In the TABOR language, when we talk about the entity gets local growth and inflation, inflation means the percentage change in the U.S. Bureau of Statistics Consumer Price Index for Denver Boulder, all urban consumers or its successor index. The inflation rates are also projected by Legislative Council and the Office of State Planning and Budgeting. So if you don't know, the Legislative Council is a nonpartisan group of researchers and economists that work with the legislature, and they research and flesh out all of these ideas, and they project what's happening in the economy and where property values might go and what might be happening so that the legislature has some basis of what's in budget every year. And the Office of State Planning and Budgeting is the economic office in the governor's office. So where they think the economy might go and how that can affect what they're going to do. Those numbers that they project for inflation are available on DOLA's website. I've included the link, and I might pull it up later to show you guys just so you know what it looks like. But I don't want to step on Cynthia's toes because she's also going to talk about that a little bit. But the inflation number is a number that the entity can pick from any of these sources. And so there could be some strategy later on when we're looking at what values we're filling in on the form to come up with the limits, which number we pick, because they're not always the same, and each, either the federal or the Legislative Council or OSPB might have higher or lower numbers. And then local growth, that other piece that the entities get for increasing their budget over last year. For school districts, it's simply a change in student enrollment. So we look at how many students are enrolled, and the change over last year is what that local growth is calculated as. For the non-school districts, it's a little bit more complicated, and there's a few more pieces that go into it. They look at the percentage change in actual value of real property from new construction, destroyed and demolished property, and other additions to or deletions from the tax roll. So what that means is, we look at what last year's value is. If there's new construction, the percentage change that we get for that, we get to levy extra for that new construction. If there's destroyed or demoed, that counts against that percentage change. And then other additions or deletions from the tax warrant is a little vague, and we have a handful of things that have been added to define that on the form. If we jump over to the second limit, it's the statutory property tax revenue limit. So it's 5.5% revenue limit found in Title 29. This one is statutory, which means hypothetically, on a whim, our legislature could write a bill, introduce a bill, pass it, and change that 5.5% to any number that they want. When it first went into effect back in 1912, the limit was a lot higher than 5.5%. It has slowly gone down over the years, and it's been at 5.5% now for, I think, a few decades. But it can change just depending on what the legislature thinks these entities should get. That law was introduced as a recommendation from the original Tax Commission, which was the DPT's predecessor. So before there's DPT, Colorado had the Tax Commission that was created in 1910, 1911. And the Tax Commission's first annual report to the governor and the legislature laid out a lot of problems and ideas for fixing those problems in the property tax system. The first one that they pointed out was there is no limit on what the local entities can levy. So there were entities levying illegal amounts of money, and the tax commission said this is one of the first things we should fix in order to have some accountability and in order to make sure that they're good stewards of the money, basically, that nothing is going to go rogue and just cause problems for the government, for the communities as a whole. And so that revenue limit was actually introduced the very next year, and it's been in place ever since. So more than 100 years later. The entities have to calculate their revenue budget, their limit, under each limit. So you have to go through TABOR and say, with local growth and inflation, how much money can I get? And then under the 5.5% limit, you have to do how much do I get last year plus 5.5%. Whichever one of those is more restrictive is the limit that applies. We have an Attorney General's opinion from the year after TABOR passed, asking, now that there's these two limits, what are all of these local entities supposed to do? And the Attorney General issued this opinion saying you have to calculate both limits every single year, and the more restrictive one applies. There are a couple other restrictions on those revenue limits. In TABOR, we have a restriction that the mill levy cannot increase unless approved by voters. In TABOR, we also have that no assessment rate can increase unless approved by the voters. So this assessment rate not being able to increase has led to what we call the ratchet down effect on the residential assessment rate. It started out at 21% back in 1983. As we went through the years, the actual value of residential properties increased exponentially compared to the value of all of the other classes of property. So much now that 80% of the value in the state is in residential properties. Only 20% is in commercial properties, in the oil and gas production, things like that. So it's pretty crazy to think about. 80% is people's homes, and that only 20% of the value is in, all of the high rises in Denver, all of the ski country, resort area properties that have quite significant values. plus the huge amount of oil and gas that we produce in the state only amounts to 20% of the total value. So because of that, the residential assessment rate has dropped over the years. In 2003, it dropped to 796, and that's what most people were probably familiar with because it was 796 for many, many years, from 2003 through 2016. In 2017, it dropped to 7.2. And then last year in 2019, it dropped to 7.15. And the curious thing is that every year it was 7.96. The Division of Property Taxation calculated the residential assessment rate study and came up that the number should actually go up. The rate should have been higher every single year in order to keep the Gallagher Amendment's 45-55 split between the two tax bases. But because of the language of TABOR, we have an increase must be approved by voters, and we get a legislature that does not want to take that to a vote of the people. They would have had to put it on the ballot for the entire state to either approve or disapprove of that residential assessment rate going up. And so it's never been asked. But if the legislature did want to raise it, they would have to go to a vote. So handout 1 should have your TABOR and 5.5% language. And I want to go through a few lines. Actually, maybe I will throw it up on the screen so that we can all look at the same material. Give me just a second. Okay. So this is TABOR as a whole, written by Douglas Bruce. There is a piece in this first paragraph that is worth noting. Okay. So, its preferred interpretation shall reasonably restrain most the growth of government. We are subject to this idea that interpreting these provisions in TABOR is that it's supposed to restrain the growth of government. And other limits on district revenue, spending, and debt may be weakened only by future voter approval. So this sets us up for that requirement of having to ask the people for a vote in order to change the limits that are calculated here. All of the definitions, the term definitions, are laid out here. The ones that we're concerned with are inflation. So it tells you USPB Consumer Price Index, and this local growth piece for non-school districts, and the change in value for all of the other districts. On the second page, and this is really fun reading, and it's worth at least reading through once, I think, because there is a lot of information in here. It lays out exactly what has to be on the ballot language so that an entity can increase its limit. And Douglas Bruce wrote this with the idea being to restrict the growth of government, when you look at the language that it has to have, it sounds bad to a taxpayer who's voting on it. It asks, shall such districts' taxes be increased annually? And so the question that it has right off the bat is, should taxes be raised $5 million? And that is in the Constitution for how that question has to be worded on the ballot. And so any sort of change like this, they're all going to look the same and start off with the same shall taxes be increased X amount of dollars. Spending limits under number 7 here give us that the annual percentage in the state fiscal year spending equals inflation plus the change in state population in the prior calendar year. And then each local district's fiscal year spending equals inflation in the prior calendar year plus annual local growth. So the state budget is also under a TABOR limit, the same as all of you guys. For those local governments, it gives us that it's simply inflation plus local growth. And it also says this change in each district's property tax revenue equals inflation in the prior calendar year plus annual local growth adjusted for property tax revenue changes. So it gives us the two definitions here for the fiscal year spending and the property tax revenue. There's more for revenue limits under 8. The first and biggest one being no new or increased transfer tax rates on real property are prohibited. And no new state real property tax or local district income tax shall be imposed. And the tax income rate shall apply for the next year. This lays out that if the state or any local government wants to increase a tax or create a new tax, it has to ask the people. And asking the people is a little bit more difficult than simply having the people elect representatives who will create this tax. And so there are some things where it looks like they're trying to get a workaround by issuing fees for something. And if you have like a fee for some sort of product or something, people might argue that it is a tax, but I think the courts have sort of defined the fees. The fees do not fall under this, and they're allowed to fund government operations if they are all going directly to one specific project or one specific goal. Taxes, as a general idea, go to fund the government, and they're divvied up and spent on all sorts of things. But if you have like a plastic bag fee in grocery stores in order to fund a recycling plant for plastic, that is not a new tax. Also under revenue limits, we get that each district can enact uniform exemptions and credits to end business, personal, property taxes. So a lot of, maybe I shouldn't say a lot, there are entities at the county level and municipality level that have done this. They have eliminated business, personal, property taxes. And then regardless of reassessment frequency, Valuation notices shall be mailed annually, may be appealed annually with no presumption in favor of any pending valuation. So TABOR goes so far as to start telling the assessor's office now what they're going to have to do to notify people and what their rights are going to be. So in the past, there was not a requirement for those valuation notices to be mailed annually. Now you have to get one every single year because of the Constitution. And they can be appealed annually with no presumption in favor of pending values. There used to be a presumption in favor of the assessor's value, and that the assessor had done it correctly and it was on the property owners to prove otherwise. Now, under this constitutional language, if somebody is not happy with their property value, they go into any sort of hearing on equal footing as the assessor, and all of the evidence is looked at and judged with nobody being sort of favored as having the right one. The second part of this handout is the statutory property tax revenue limitation. And this statute lays out in, just as few words, all of the definitions and pieces that go into calculating the limit under this piece. So what is worth pointing out is that each fire, sanitation, and all of these districts established by law this tax levies for all of these districts shall be reduced as to prohibit the levying of a greater amount of revenue than was levied in the preceding year, plus 5.5%, plus a few other things. So this one includes the amount of revenue abated or refunded by the taxing entity, less the amount of revenue received by the taxing entity as taxes paid on omitted property, and it goes on. The main takeaway here is that the levies are last year plus 5.5%. Okay. I would recommend, again, read through this at least once. Maybe if you have a night that you can't fall asleep, or a night where you just have so much energy. This is totally fascinating and very carefully crafted in terms of what pieces go in, and the language is precise in capturing and defining what all of those pieces are. And if you read these things and understand them, everything that you need to know for that certification of values form for having the levy ultimately be correct and certified, it's in this language. Okay. We're going to jump back over to the PowerPoint. Value reporting, the different components of the certification of value form. So we're going to look at the form in detail and go through all of the different pieces and components that go into it, because the language that was written in the Constitution and in the statutes, we had to take that language and create a form so that we got all of those numbers. 5.5% versus TABOR. So a lot of the the material going through the information on the form, it's comparing and contrasting what pieces go into one revenue limit versus the other. And the form is divided on the top half and the bottom half. You have each of those limits. At the most basic level, on the top half of the form for 5.5%, you're going to get assessed values from the assessor. So that's all of the actual values times the assessment rate. That's the actual tax base. It also includes personal property. And when we go to the bottom half of the form and we're looking at the values included there, they're always actual value. So Douglas Bruce wrote in the Constitution that actual values are supposed to be used. And it also is that actual values are supposed to be on notices of valuation. In order to be more friendly to property owners, it's helpful for them to see the actual value because it's something that we think of a lot more easily. You know, there was headlines that the average home in Denver just passed $600,000. That's sort of a value or an idea that we can quickly conceptualize and understand based on the market value. If it said that the assessed value was $24,000, well, nobody talks in assessed values. And so the bottom half of the form with TABOR is doing actual values. It does not include personal property values. So when we go through and look at some of those buckets of what falls into these categories, the personal property values are pulled out. And the total value for the TABOR calculation includes all of the DPT exempt properties. DPT exempt properties are the 11,000 or so properties across the state that are used for strictly charitable or religious purposes. So the assessor's office is supposed to have values on all of those and include them in that total value. Oops. Handout 2, which we'll go through as well, looks at those two halves of the form. And the form, when I pull it up, it looks terribly complex. I don't like looking at it and trying to show somebody that doesn't know anything about the form what's going on. It's a little more intimidating. This slide right here captures what the basic calculation is. If you just look at what it is for all of these lines, what's happening. To get your 5.5% revenue limit, you get last year's revenue plus any revenue from growth. And remember, the growth includes new construction. So houses going up, skyscrapers going up, annexations, so boundary changes for an entity, and other growth items. So last year's revenue, suppose we had almost $1 million in growth in assessed value, and we multiply that by last year's mill levy. And that gives us what the revenue from the growth would have been for last year. Under the new expanded revenue base, so we are adding the 129, 601, and the 807, we get 130, and we multiply that by the 5.5% limit. So 130 times 5.5% gets us 137,580. And suppose the assessor's office certified to this entity that the assessed value within the boundaries is 164 million. That simple division will get you 0.0839 as the mill levy. So that's the most basic thing that it does. And it's easy, and it took me a while going through the form and going through this class and another class that the DPT offers for certification to just wrap my head around what is happening. Because there's a lot of very specific numbers that the assessor puts on that form, and breaking it out like this, I think, really helps show what the revenue limit does. Is that we get last year's revenue plus a revenue from growth, and that new tax base is multiplied by 5.5%, and that's what the entity gets. Now for TABOR, it's a little bit different. Remember, these are all actual values. So we get net growth, which is equal to current year's growth less deletions. So the growth items are just over 8 million. We look at last year's value, so 1.391 billion. And we get a rate of growth. So remember, it's the change in value. It was talking about the change in value for these pieces. What we look at is how much did it grow, and then divide it by last year's growth. Last year's total valuation in order to get a percentage, a rate. Then we get what was last year's revenue. We multiply it by that growth percentage, and we have a new revenue limit. Again, you take your revenue limit, what you need, divided by the assessed value in that entity to get a mill levy. So the basic TABOR calculation, we're looking at what is this value change, and then compared to last year, we flesh out an actual rate, and then we say whatever last year's revenue was times this rate gives us what we need at the end. A couple things that are on the form. It talks about total value, previous year's total value, and the current year's gross total value. So on the 5.5%, it's the assessed and taxable value of all real and personal property. It also includes the difference between the gross and the net for the TIF increment. We're gonna barely talk about TIF because you can get into the weeds so easily on that. And if you're a TIF person, the DPT has a TIF class that's very nice, very informative. And then if that entity had enacted any sort of personal property exemption, we are taking that out of the gross total value. TIF includes downtown development authorities and urban renewal authorities, and it is created to be a vehicle to finance infrastructure. For Colorado, how that works is that there's going to be some TIF plan going into place over some area of land. And that area of land, when this plan is created, we establish a base value. And the base value is just the last value that was certified that was certified for all of the properties in that boundary. The base value can be adjusted for general reassessments and boundary changes and appeals. As time goes on, in that area, in that TIF area, new construction might be happening. They might knock old blighted buildings down and start creating a new community, a new senior living center, whatever they're creating. Over the years, that adds value to the parcels in that plan area. Any value that is above the base value that was established is called the increment value. So for certifications, you have your gross value minus this increment to get a net value. We take that increment out because the property tax revenue that is attributed to it does not go to the entities, but it goes to fund that infrastructure. And this is sort of the first 2 years of what a TIF might look like. When a base is established, property might be destroyed or ownership transferred to those authorities, and the values might go down. But as new construction begins, we get a base rate of whatever the property was when this whole thing started, and then an increment that goes to what new improvements have gone onto the property and that change in value. One good example of this, Laura has shared every single time that we talk about TIF, is a senior living center that's built out sort of near Parker, I think. And it was TIF'd onto ag land. And in Colorado, ag properties get a very favorable property tax valuation. The property is assessed and it's valued based on its earning or productivity, which generally creates a value that's much lower than the market value of what that property would sell on the open market. So you might have values of less than $1,000 an acre when on the open market it would sell for many times that. So a TIF plan goes into place on this ag area, and they build a senior living facility center. The center goes up, and all of the value associated with that improvement goes to fund that infrastructure. The money that the local entities get is still based on the rate it would have had as if it were still agricultural. So that creates sort of a difficult time if you have ambulances or fire districts going out all the time to service this property, and the property, it's now has obviously much higher demand for those services, and the entities are not receiving any of that money. The money is going to pay off bonds that were issued to create that improvement. Okay. Abatements are another chunk that we throw in. Abatements, if you're not familiar, are refunds of money or a reduction in tax. And so if there's an issue with a valuation, or if somebody takes an appeal all the way up to the Supreme Court and gets and is right and gets a lower value, then an abatement petition will go through to change that. For purposes of certification of values, we look at the taxes abated on a fiscal year from August 1 to July 1. And the county treasurer should supply that information and it's reported to each entity in proportion to the mill levies. So abatements, as it is a reduction in taxes or a refund of money, that's money that the entities had budgeted and planned on receiving, but now do not. And so it's thrown in here as a way for entities to recapture that money and remain whole. That way there's not, a problem in this system where we certify values and everything is neat and tight while they go through all of the numbers. And then lo and behold, we get a bunch of abatements and now the entity can't make payroll or something like that. So the abatements are thrown in here so that they can levy against that and capture that money back. After abatements, new construction is another piece that goes into the calculation. Okay, for these last few slides that talk about the components that go into the value reporting, we have sort of broken it down and simplified what the assessor's office is going to put on the form on the top half and the bottom half for the 5.5% TABOR, so that it's easy to see where the differences are and what these numbers represent. So for new construction, under the 5.5%, remember it's always assessed value. It includes new personal property if it is associated with a new building. So if a new commercial building is going up and there's personal property associated with that building, there are instances where that can be captured as value in new construction. That new construction might take more than 1 year to finish. And so the assessor's office can report either the prorated amount each year or 100% of the value of the improvement when it's actually finished. Under TABOR, it's simply going to be the actual value, and there's not going to be any personal property found in that new construction piece at all. The TABOR piece also allows the assessor's office to report either on the prorated amount over the different years where new construction is happening, or 100% at the very end of the new construction. Increased mining production. So under 5.5% limit, the assessed value of the 6,000 class of properties increased production. This includes land classified as producing mines and natural resource property. And it's the actual value of production from any new mine or new coal or sand and gravel property. The increase in value from the production of an existing producing mine. And to calculate that increase, we look at the tons of product that are pulled out of the earth multiplied by a value per ton. There's no assessment rate really associated with those producing classes. And because we're just looking at valuing sort of the product that we're pulling out of the earth, there's no personal property either. On the TABOR half, it's the actual value of increases for any of the production 6,000 class properties, and the actual value of new coal and sand and gravel 5110 and 5120 properties. A change in taxable status is another thing that might be captured. So for the 5.5% limit, it's the assessed value of previously exempt federal properties. And it includes the personal property. And then under TABOR, it's the actual value of any real property changing to exempt status, or the value of any real property changing to taxable status. So when properties get bought and sold by government entities or by anything else where it'd be exempt or go taxable, that change in taxable status is a value that's going to be captured and flagged. Increased oil and gas. So for the 5.5%, we're looking at just the assessed value of any new wells. Not just, well, it's not going to be any shut-in wells that go into production later, but it has to be a completely brand new well. And the same for TABOR, it's the actual value of any new wells, and there's no personal property associated with that. Destroyed property, it is not separately reported on the 5.5%. And under TABOR, you do get the actual value of the destroyed property with no personal property associated. And if it is a demolition, sort of like the new construction, over multiple years, that prorated amount can be reported, or the full value of the property can be reported when it's totally destroyed or demolished and the value is 0. Disconnections or exclusions. So for some boundary change, the values of those properties are not separately reported in the 5.5%. In TABOR, because that's going to be seen as an addition to or a deletion from the tax roll, we are going to capture the actual value of all of the real property and no personal property. Abatements, the assessor, like I mentioned before, gets a report from the treasurer for the 5.5% because that statute reads in a way that lets the entities levy for that money that they were expecting to get. Under TABOR, when you think about local growth and inflation, abatements are not going to be separately reported in there. They're not part of the calculation. Okay. I was thinking of pulling up handout 2. It is quite long. As you may have noticed as you're going through the PDF, it has sort of a cheat sheet in there that's helpful because it goes through every single line. And a lot like what I just did explaining the lines, there are some definitions that we've added in there, and then the instruction sheets, and it walks you through the entire thing. But I want to make sure to give Cynthia her amount of time, and so we're just not going to pull up handout 2 as a group, but you have that as a resource, that all of those blanks in the form have a corresponding definition or information that we've added to clarify what it is. Filing requirements is sort of the last piece for what I'm going to do. For certifications, the assessor's office has to certify values to all legal taxing entities, even if they have never levied a property tax. And the assessor doesn't think that they will. If they are an entity in good standing, they are supposed to get a certification every year. Newly formed taxing entities have to notify the assessor by July 1 to levy a property tax that year. And those certifications go out August 25th to each taxing entity. Now, this year, the governor issued executive orders, and the State Board of Equalization, which controls the property tax world, really, adopted some emergency rules. And so for 2020 only, as far as we know, those values are going to be certified on October 13th. So the assessor's office was given a little bit more time over the summer and now we're compressing the last part, between August 25th and October 13th. We've lost some time, and starting October 13th, the entities are going to receive their certification of values forms in order to start budgeting. Non-school district certifications are filed with DLG, while the school certifications are supposed to be filed with the Department of Education. For those counties using the alternate protest and appeal procedure, the assessor's deadline to mail NODs was extended to September 16th, and it was August 15th. So that on the alternate pushes it out. Values are certified to entities on October 13th. And those values that are going to be certified for those specific counties are not going to include CBOE changes. And now, as you know, CBOE changes can be pretty significant, and any CBOE change really is important to capture in the final certification form so that these entities are not levying against a value that the commissioners, that the Board of County Commissioners had already previously adjusted. So it's going to be very important for those entities as they are budgeting to be aware that there could be some changes that they're going to have to get in last minute when that new certification form comes in that reflects the CBOE changes. The second recertification of value must be recertified prior to December 10th. That date hasn't changed. We recommend trying to get the information out of the assessor's office to the entities no later than December 1st to try to give those entities a little bit of additional time to track down people who might be out of town or volunteers. And those values are also recertified to DLG and Department of Ed. And what the entities have to do is adjust their mill levies based on the new numbers. So they have to sort of run the calculations again in order to make sure that their final mill levy that they want to certify is based on the best known numbers from the assessor's office. And this just lays out what the entire timeline looks like from the assessment date to the tax warrant on January 10th. August 25th, you get a certification. Cynthia will talk about the October 15th. Estimated budgets are prepared and adopted. And then going into December, the last few things wrap it up with a recertification of values, and then entities certifying their levies to the commissioners, and then ultimately the commissioners levying the taxes. I have sort of already mentioned why values would be different between August 25th and December 10th. It's any sort of appeal or change that happens. It could be a state assessed property, which are all of the public utilities, and you have a list of what all of those utilities are in the state. The values for those public utilities can change in that time frame between August 25th and December 10th. Because the company or county has until August 31 to appeal their value to the BAA. So they're on a slightly different time schedule compared to the CBOE in the counties. And so any changes that do go through on state assessed values have to be captured in that recertification of values in December. The values in state assessed properties are overwhelmingly in personal property. And sometimes those companies do not report their split of real and personal property, which is needed when you look at, if we're looking at TABOR and we have to pull out personal property. These are some of the numbers that we recommend to use for those splits if they do not report to the assessor's office what their real and personal property is. And then the last piece is the certification of levies and revenues from the entities to the commissioners, and then the tax warrant. So entities have to certify their levies to the commissioners by December 15th. You have that whole certification in handouts 3 and 4. You have a computation of the mill levy on there, and it has all of the steps laid out just like the certification of values form. And the commissioners are going to go through those and certify them by December 22nd. The certification of levies and revenue form, if you have a printer with legal paper, it prints out extra big on legal paper. And 4 copies of this are certified by the commissioners. Who gets the most important copy and is the last line of defense for ensuring the accuracy of the numbers that are on this certification in terms of actual revenue numbers to the penny and value numbers, and it's the assessor. The other 4 copies get sent to the property tax administrator, the Division of Local Government, the School Finance Office, and the Board of County Commissioners to keep. If the entity fails to levy and then they do not get their stuff in by the statutory deadline, contact DLG and you might be directed to extend last year's levy. Levies must be adjusted to reflect the values reported on your entity in December. Okay, and then the tax warrant. The assessor is going to receive information about every entity, and they're going to take the mill levy and extend it across the assessment roll to tax every appropriate tax area with the right mill levies. When the property owners start receiving their tax bills, any temporary tax credits have to be itemized on the tax warrant and on those bills. And that tax warrant is due to the treasurer no later than January 10th. And it has statutory language that says the assessor shall so command the treasurer to collect these taxes. And that warrant is the authority for the treasurer to collect those taxes and make people pay. And now a couple of changes. There was really only one that we were concerned about for this piece with the certifications, and that was the the September date from the August 25th date. The August 25th date for certification of values being pushed out. I have attached a calendar for you guys that shows all of the other dates that were moved. And so a lot of the dates were earlier on in the year with some with some notices having different dates and timeframes. And so if you ever need a reference to go know what is the actual filing deadline for some of these forms, it is going to be on that last calendar. And then there's another handout for the de-Gallagherizing memo. This sort of became a thing last year or the year before, when we were expecting and we were putting out a report that showed the residential assessment rate was going to start going down. The de-Gallagherizing term lets assessors, it lets these entities try to retain the same amount of revenue that they would otherwise normally have if the assessment rate were to drop. And so in order to calculate what that is, assessors will have to provide taxing authorities actual residential value. That is not a number that's broken out anywhere in any of the forms to be used. And the entities can use that number to calculate their revenue limit. And the revenue limit is going to be very specific to the way that the ballot language was written when an entity proposed to all of its constituents on a vote where the revenue should be based on a change in the res rate. And so the assessor's office does not get involved in telling these entities what or how to calculate it, and that they should contact their attorney or whoever worked with them to create that ballot language. But I thought it was worth mentioning, keeping it in here, because we might see the res rate drop or change next year based on what happens in November, based on what the next General Assembly session contains. And so this is probably constantly going to be a thing for the next few years as we figure out, a lot of rural entities that are struggling to create a tax base on residential properties, with the residential assessment rate just shrinking and shrinking that tax base. And with that ends my piece. I am going to turn it over to Cynthia Thayer so that she can share her PowerPoint slides and start presenting.
Thanks, Thomas.
You're welcome.
Can you see?
Yep, that works.
Awesome. Okay. Well, thanks, everyone. I'm Cynthia Thayer with the Division of Local Government, also in DOLA with the DPT. And today I'm going to cover, Thomas, would you mind muting? Thanks. I'll start with just a brief overview, an introduction to the division, especially for county assessor folks who may be less familiar with DLG than they are with the Division of Property Taxation and DOLA, and then go over just a general overview of local government budgets and specifics in the local government budget law, and then some of the legal limits that Thomas talked about in his presentation. We'll do an example of a property tax, of the 3 limits for property taxes for local governments. All right. Local governments in Colorado, I looked at this presentation from when we did the class last year, and there were just over, last year there were 4,019 active local governments in Colorado. As of a couple of weeks ago, there are over 4,100. Most of that growth remains in metropolitan districts, which is a common financing tool and tool to provide services in a new development, which is why that remains where most local government growth in the state is. With just shy of 2,000, about half of the active local governments in Colorado are metropolitan districts. All right, in the division, we have 5 teams. I am in the local government services team, and our team, most of the filing requirements that local governments have with the division reside in our team, including budgets. We also have subject matter experts who specialize in special districts, local government finance and budgeting, elections, and water and wastewater matters. The financial assistance team has about approximately 20 different grant or formulaic financial assistance programs for local governments. The busiest right now, maybe 21 financing programs. Certainly the busiest one right now is we have part of the state's allocation of coronavirus relief funds, about $275 million, I believe, for local governments. The Community Development Office has a Main Street program and work with municipal governments in Main Street revitalization, also work with local governments in land use planning. The Colorado Resiliency Office is the newest team in the division, and they help local governments and communities with recovery from and help them with recovery and resiliency activities in the face of challenges, especially natural disasters, but they are certainly very active right now helping communities with pandemic recovery and stabilization sort of activities. And then the division field team, we have a series or a network of regional managers and regional offices in the state. And if you go to the division's website, over on the left-hand side, there is this map and contact information for each regional managers. But they help with intergovernmental cooperation, intensive technical assistance with local governments, community development or project development, disaster recovery. They are also usually the place to start if you're with a local government and have questions about any of the financing or funding programs that the division has. Start with the regional managers, and they can help you with the application process. All right. Now, local government budgeting in general, why do we do it and why is it so important? Well, first, it's required. The General Assembly has said it's such a vital piece for local governments that it is required. And then after you've adopted and completed the budget process, file a copy of that with DOLA to demonstrate that you have adopted a budget. But it's more than just that the law says you have to do it. It's a key communication document for the board to communicate their goals and priorities and turn their goals and priorities into operations. It's an accountability and transparency document. And again, it reflects the boards and policies and plans and is a way to allocate resources to turn those policies and priorities into operations. All right. So when it comes to various policy activities and policy documents for a local government, the annual budget is probably the most prominent policy or planning activity that a board does every year. But it has its limitations, mostly because it's relatively short-term in scope. It's a year document. And there's little opportunity in an annual budget activity and document to identify those long-term goals and long-term implications of decisions. And that's where all of these other planning activities that a local government does are so important also. And 3 examples would be strategic planning or capital improvement planning activities, long-term financial planning, where a board and local government is identifying important financial policies and things like that. And then where the budget comes in then is the annual budget is sort of in service to these other planning activities that's happening all the time and puts those plans into action and turns those plans into operations. And then ongoing, the board and staff are reevaluating these plans, financial policies, their fiscal health, and potentially realigning those plans and re-strategizing. When it comes to some of these best practices that the budget law doesn't touch on, I love the Government Finance Officers Association. They have a lot of free and a lot of resources that aren't technical either to help explain some of these long-term perspective and planning activities and other best practices. There's also a Colorado chapter, and I failed to put that up here, but it's just cgfoa.org, which is a great training and professional resource for local government finance officials in the state, and including those of you who might be new to local government finance. They do ongoing training throughout the year. Both the CGFOA, which will give a Colorado specific focus, and you'll receive training from Colorado peers and CPAs in local government finance and things. And the national GFOA also does great training. And then the GFOA also has a website for fiscal first aid resources. And they've had this site since the Great Recession, but have really resurrected it in the face of pandemic and the financial challenges and budget challenges to local government. Great resources there as well. Okay, so next let's talk about the Colorado local government budget law. The budget law, I'm going to touch on really two sort of components of the budget law. The budget law talks about some milestones as far as what process local government should be going through when it comes to budget adoption. And then the budget law also talks about various content and format requirements of the budget document itself. I don't want to forget, because I often do when I do this class, that home rule municipalities and school districts are not subject to the local government budget law. School districts are not at all. As Thomas mentioned, they have a whole other section of statute and have budget and finance requirements. It's just not within this local government budget law within Title 29. Home rule municipalities are required, the piece of the budget law that says adopt a budget and file it with DOLA, home rule municipalities do have to do, but the content and format and other pieces of the budget law, they do not have to follow, though frankly most of them do, because a lot of the format and content requirements of the Colorado local government budget law are best practice anyway. So the first sort of milestone that the budget law talks about is budget estimates, and it says that spending agencies are required to submit budget estimates to the budget officer. The budget officer, the budget law says, is the person that the board is designated to prepare the budget. So for many local governments, that is the finance or budget director. It could be the town clerk. For maybe smaller volunteer-run local governments, it's one volunteer or the one paid staff that a board has. And there's no deadline on when these budget estimates should be submitted to the budget officer. But the first deadline that does show up in the budget law is this October 15th deadline, where then the budget officer takes these estimates, compiles a draft or proposed budget, and submits that to the governing body. And this year, the challenge and a lot of questions we're getting from local governments, and probably those of you in assessors' offices are starting to hear this concern as well, is that executive order that Thomas mentioned that this year is delaying the certification of value from August 25th to October 15th, and also delayed some other reporting and requirements related to property tax. That executive order did not change the statutory October 15th deadline. So, especially for local governments with property tax revenue, this October 15th deadline is still a statutory requirement, but what we've been telling local officials is probably the October 15th budget is going to be more drafty than in past years this year. So I think the key is to be transparent about that to the board and to the public, that this October 15th budget, there will probably be a week or so days later a second version of this proposed budget when you have a better sense from that first certification of value of the property tax revenue. And then the budget law says, upon receipt of that proposed budget, the governing board shall publish information about the budget hearing, a statement that this proposed budget is available for public inspection, and a statement that any interested elector may file an objection to the budget. For smaller local governments, let me see, I believe it's 50,000. Yeah, local governments whose proposed budget is 50,000 or less can cause to be published this notice in 3 public places within the jurisdiction. For local governments whose budget is more than $50,000, they shall publish this in one time in a newspaper that has general circulation. In other local government statutes that are getting more modernized, online posting is possible. I don't think that as of yet, the budget law, though, still has this newspaper and physical posting language. So frankly, these days, probably a lot of local governments are complying with this by posting it in the paper, but also are putting something on their website or other electronic ways that they're more traditionally communicating with the public. After posting, then there's a budget hearing. And this is where the public has an opportunity to comment on this proposed budget. And usually this is happening at the same meeting as the next dates or process in the budget law, which is budget adoption. And as Thomas has already talked about, for local governments that levy property tax, this adoption has to happen before the mill levy certification to the county. So that mill levy certification is a certification that the board took this action. And so in order to meet that December 15th certification deadline, the board has to have adopted the budget. So the budget adoption is also December 15th for entities that levy property tax. But some local governments don't levy property tax. For example, water and sewer districts often just provide service and rely on user charges, for example. And local governments that do not levy property taxes have up until the last day of the prior year to adopt a budget. Though even for local governments that don't levy property tax, we think it's good communication to the county to close that communication loop and let them know by December 15th that we don't levy property tax. Just so especially larger counties that have hundreds of local governments, it might not be obvious to them that a local government isn't levying property taxes. So even for those that don't levy property taxes, a communication to the county is always a good idea, that we have 0 mills. We do not expect a mill levy certification. All right, and then again, that mill levy certification by December 15th. And then the last deadline in the local government budget law is file the budget by the end of January with the Division of Local Government. And certainly the recommended filing method is we have an online e-filing portal. And if you as a county get local government questions, don't hesitate to refer them to the division, and we can walk them through how to get a user ID and file a PDF of their budget document. Our budget review is frankly limited to, we will check it for the content and format requirements that the budget law requires and make sure it was adopted. So we'll check for resolution ordinances and things, but we are not reviewing it for local priorities, how they're spending their money. That's a local matter and not part of the budget review when they're filed with the division. So let's go through some of those formatting and content requirements that the budget law talks about. First, the budget law talks about it requires a written budget message and does discuss some of the requirements for what a budget message is and what it should contain. It says that a budget message should include the important features of the budget, and important features is really that's a local choice on what a budget officer and the governing board deem important to communicate. The budget message must include a statement of the budgetary basis of accounting, whether it's cash, modified accrual, or encumbrance. And then a description of services. And we see a huge variety. Some local governments hit these in 3 sentences, and others treat it as also their true narrative with photos and really a story to the public about what the budget is and what services the budget reflects. So I have a couple of examples here. This is Cortez Fire Protection District, and in their 2020 budget, they talk about immediately the services and important features of the budget. And then there's the statement on the basis of accounting. And then they go on to talk about the mill levy and then some of that narrative about actual firefighter activities and some cooperation with neighboring districts. So they've hit the bare minimum, and then in just a couple more paragraphs also talk about some other important features that they deem important to communicate. And then the budget law talks about the actual schedule of where the numbers are, the schedule of revenues and expenditures. And these are some of the phrases that the budget law talks about. It says it should be a complete financial plan by fund and spending agency, and should have explanatory schedules of expenditures by object and revenues by source, and then should include 3 years of comparable data. So for a 2021 budget, that would be a 2021 budget column, a 2020 estimate column, and a 2019 actual column. And here's an example from the North Lamar Sanitation District. This is their 2020 budget. Which this is just a single purpose. They provide one service, one fund. There are 3 columns. These are the revenue sources for this local government, and they do have property tax. Most of the revenue, it looks like, is from charges, which is very common for a sanitation district. And then expenditures, again, the 3 columns, and then total. And then the budget law talks about estimated beginning and ending fund balances. And for most local governments, they are doing that. Here's again, North Lamar, all on one page what I just showed before in 2 slides, but this is the most common presentation of beginning and ending fund balance, showing the beginning fund balance up above revenue, and then after the net of revenue and expenditures in the year, where the ending fund balance is. Another content requirement of the budget law is a supplemental lease purchase schedule. And we at DLG don't have any information on what local governments have a lease purchase schedule. So this one is really up to a local government to be aware that this is in the law and comply with it, because we don't have a way to know who is and is not providing the schedule. But the schedule, we have a template on our website that hit the content requirements that the budget law requires. Though certainly local governments also can comply with this in a couple of sentences as well. But really it should have the total amount and the total maximum payment liability down at the bottom. I pulled this, I think, from a park and rec district. So their only leases are 5 golf carts for 2020, but it's not a huge, as far as pages, it doesn't take up much, but do be aware that this is also a content requirement in the budget law. Some other requirements then in the budget law says no deficit spending. But one common question we get is, well, if we are using reserves this year for a big project that we've been saving up for, is that deficit spending? Expenditures in excess of revenues plus existing fund balance would not be deficit spending. So deficit spending would be if the budget plans to spend more than new revenue plus fund balance. That would be deficit spending. And then the budget law requires resolutions or ordinances to adopt the budget, to make appropriations, which is where the board is setting the spending limit through the appropriation, and then adoption of the mill levy. Most local governments comply with these 3 resolutions or ordinances in separate resolutions or ordinances, and this is an example from Western Rio Blanco Metro Rec and Park District. This is their resolution to adopt the budget, and then after adoption of the budget, they appropriate money to reflect that budget adoption and set the spending limit or the appropriation for the year. And then their resolution to set the mill levy. And the mill levy is down in section 2 here. All right, and so those examples I pulled right from when local governments file the budget. We will check it for the content and format requirements, and if they're good, we publish it on our website with all 4,000 local government budgets, minus school district budgets that the Department of Education has. And so these examples aren't the only way to comply with the budget law. There are all kinds of examples here on the division's website. Some other pieces of the budget that are very common and common questions we get around budget amendments and changes to the budget. So the General Assembly, when they've passed this budget law, acknowledged that what's adopted, things change. We certainly know that this year more than ever. And the budget adopted in early December might not be what's ideal or what's needed later throughout the year. So the budget law defines different scenarios where the budget can be adopted or budget can be amended. One is through a transfer of appropriated money. let's say that a board has two funds. They appropriated the general fund and then maybe a capital fund, for example. The budget law says you can move some of that appropriation from one fund to another. So you are taking some of that appropriation and increasing another fund's appropriation. Though that kind of budget amendment would require another budget hearing in that same posting process. The budget law also says you can move line items within one appropriation. So a general fund appropriation, elements or lines within that appropriation can move up and down. That kind of change certainly would be discussed in a public meeting, but doesn't require the same budget hearing that an increase in the appropriation kind of budget amendment would. Another really common kind of budget amendment is a supplemental budget and appropriation. And this is where there's unanticipated revenue that wasn't part of the original budget, maybe a grant that the board didn't foresee when they adopted the budget, and now they have secured. So they would adopt, again through another budget hearing, adopt a supplemental budget and appropriation for that new unanticipated revenue. What's an interesting thing to call out, though, is the budget law says that you cannot do this, you cannot adopt a supplemental for unexpected property tax. Unexpected property tax revenue, you have to wait until the next year and roll it into that new budget. So I don't know the history of how that came to be in the budget law, but just beware of that too. And then the other kind of change to the budget that the budget talks about is the revised downward appropriation. If revenues come in lower, maybe, and the board needs to make some serious decisions on potential cuts or how they will balance the budget, they can revise the appropriation downward. This kind of budget revision is a may in the budget law, not a shall. So increasing the appropriation through supplemental revenue or a transfer of an appropriation, the board must adopt a budget amendment. A downward revision is up to the board if they want to readopt. And then the budget law also talks about contingencies. And this is where if there's something that the board didn't foresee when they adopted the budget, and again, this is certainly a year where you would potentially see this, they could adopt a budget contingency where, let's say, they're going to take some of their reserve balance that they didn't initially appropriate and adopt a resolution. Again, they would have a public meeting for this and adopt a contingency, budget contingency. Now, the budget law does not define emergency. And so TABOR does talk about, for the emergency reserve, what an emergency. TABOR mostly talks about what an emergency is not, and so we can extrapolate from that on what would qualify as a TABOR emergency. This contingency, I think, is something that doesn't have to meet that same definition. And so local governments, we recommend that they talk to their attorney about the budget contingency, but just be aware it could potentially be something that they deem unforeseen and qualifies as a budget contingency kind of emergency in the scope of the budget law, and it isn't necessarily a TABOR emergency. Some other statutory aspects of budget adoption that especially are relevant to assessors: failure to adopt the budget or certify the mill levy. Failure to adopt The budget is within the budget law in Title 29. And in the event that a board, for whatever reason, maybe it's a very small local government that there's one person, there's one volunteer that makes it go, and that person just had some kind of emergency and didn't adopt the budget. Or maybe the board, this is really rare, but maybe the board is just at an impasse and does not get the budget adopted by the deadline. The budget law says so that services can still go on and everything doesn't grind to a halt. The budget law says if a board doesn't adopt the budget, 90% of the appropriation for the current year is deemed reappropriated. So at least there's a spending allowance and an appropriation until the board gets something adopted. And then in Title 39, failure to certify the mill levy, and Thomas touched on this. If a local government does not get a mill levy certification to the county by December 15th, the assessor, 39.1.111 says that it's the duty of the assessor upon direction from the Division of Local Government to extend the prior year's levy. So if for those of you in assessors' offices and assessors, if you don't hear from a local government by December 15th, contact us and we can we have a template and you can request that we extend the prior year's levy. If the entity is subject to the 5.5, we will look at that limit and temporarily reduce the mill levy to comply with the 5.5. This law says that we should do that. And entities in our records that are not subject to the 5.5, maybe voters have waived that limit. We will do what the law says, which is just look at last year's mill levy and we will direct the county to extend it. So like the failure to adopt the budget, 90% appropriation, this similarly, so something can get on the tax roll. This is another statute where the General Assembly has made sure that local services don't grind to a halt if for whatever reason something doesn't get certified. All right. And then my last piece are legal limits on the budget. And some of this will sound awfully familiar from Thomas's presentation, but we'll look at it a little bit with a little different angle, more from the local government side. So local government limits on property taxes. There are the two limits on the revenue or the dollars collected. There's the 5.5 limit in state law and the TABOR limit in the Constitution that limit the dollars. And then there's the limit on the tax rate or the mill levy in TABOR. And then some kinds of local governments also within their statute authorizing the local government set a maximum mill levy. Those local governments would still need voter approval to tax, but they, I think the two off the top of my head are downtown development authorities have a 5 mil cap, and soil conservation districts have a 0.5 mil cap, I believe. And then the TABOR mill levy says you can't increase the mill levy from the prior year without voter approval. Now, some local governments are not subject to some of these limits on property taxes, either because voters said they could exceed them or by definition. For example, school districts are not subject to the 5.5, and home rule municipalities are not subject to the 5.5 either. And these property tax limits generally apply to the general operating levy. Most of those voter approved levies, whether it's a bond levy or contractual obligation levy, those kind of levies, other kinds of special purpose levies, usually within the ballot language are setting limits, and might say, can we tax you X mills for the police department or to buy open space or whatever special purpose, let's say. For the most part, and case by case, this will vary. So locally, certainly talk to your attorney and understand your ballot language, but very generally, those kind of special levies, or like a general obligation debt levy, within the ballot language, it says, can we tax this many mills or can we tax this many dollars for the debt service schedule? And has language that makes the 5.5 or that TABOR property tax revenue limit not applicable. But again, case by case, it varies. The 5.5, which is a nickname, like Thomas said, I think back in the 80s, it was the 8-something% limit. So that certainly predates me, but my guess is that DLG and local governments used a nickname of the 8.5% limit or whatever it was. So the 5.5 is kind of a nickname. It's the annual levy law, and but we certainly call it the 5.5. That law says that the Division of Local Government is charged with tracking and enforcing it. And again, Thomas gave you that full, like the world's longest run-on sentence, but a piece of that, the actual text of the 5.5, but it says that levies should be reduced to prohibit the levying of what was levied the previous year plus 5.5% plus local growth. And local growth in the 5.5 law talks in assessed value and defines some of the local growth elements, like new construction, annexation, things like that. And for local governments, they will find these local growth numbers on that certification of value from the assessor. Because DLG is required to track and enforce the 5.5, we do the calculation. And that's why assessors are required to not only certify to the local governments, but then assessors will send a copy of all the non-school certifications to us so that we frantically go calculate the limits for those districts subject to this limit still. And we publish those on a form called the DLG 53. And on the division's website, on that same page where the budgets are on all of the tabs on the left under view filings, you can find budgets and other kinds of filings from local governments. The far right column for revenue limits is where you'll find for those entities subject to this limit. We'll have after October 13th, as we calculate the 2021 limits, we'll have the 2021 budget year DLG 53s, and then we keep the prior year's 53 up on the site as well. But in addition to DLG calculating it, we certainly encourage local governments to calculate it themselves, not only to check our math, but also it's a great exercise to help understand the components of the limit. So we also, on our website, we have budget resources like the templates for the budget law. We also have an Excel spreadsheet where a local government can enter in the certification of value data and calculate their own 5.5 limit. TABOR property tax and all TABOR limits. First, just a disclaimer, DLG and DOLA are not TABOR police, and in fact, there is not a state agency tracking and enforcing TABOR. It is locally enforced, and so this is a really general explanation that certainly local officials and board members for an understanding of their unique voter approval and TABOR status should always consult their attorney to understand how TABOR applies to them. But so really generally, TABOR places several limits on local government budgets. And for TABOR, or for property taxes, first the TABOR property tax revenue limit that Thomas has already touched on the dollars for property taxes, says that it's limited by the maximum percent change in those dollars is limited by inflation plus local growth. And TABOR defines inflation and says that it's the Denver-Boulder BLS, or Bureau of Labor Statistics Consumer Price Index, or its successor index, and which is so good that language was in TABOR, that the successor index mentioned, because the Bureau of Labor Statistics has, in the last couple of years, changed a lot nationally, a lot of geographies of local or regional CPIs, and they are now calculating a Denver, Aurora, Lakewood CPI. A common question we hear is, well, circumstances are really different on the West Slope or on the Eastern Plains or in the San Luis Valley. And unfortunately, TABOR says inflation is the Denver, Aurora, Lakewood CPI, or this regional defined BLS CPI. Oh, and Thomas mentioned the Office of State Planning and Budgeting, the governor's economists and the legislature's economists, and the fact that they project or forecast what they think this inflation number will be. And the reason they do that, well, one of the reasons they do that is TABOR says to use this inflation number for the prior year. So for the 2021 budget, it says use the 2020 CPI, or the prior year CPI. Well, the BLS won't publish what the 2020 CPI is until February, March of 2021. Well, we know that the budget is long adopted by then. It has to be adopted by December 15th. So what do? What we think most local governments do is use one of those forecasts from the Office of State Planning and Budgeting or Legislative Council. And then when the BLS publishes what the actual inflation number is, then they will go true up and see if they need to refund in the next year. And we hear a lot of variations. There's not an official sanctioned way to handle this. What we hear, though, and what I think makes sense, is to be consistent and have a documented methodology. It might be, we always use the Legislative Council forecast, or we always take the higher of the two, or we average those two forecasts, or you might know of a different economist that you trust more that's somehow forecasting this. I would say be consistent. If you're really concerned, talk to your attorney on the methodology, but just be aware that you need to go see what the actual TABOR defined published BLS inflation number was after, and see if you used a number too high, you may need to refund the prior or the following year. TABOR then also defines local growth and says that it's this net percent change in actual value. And again, the certification of value from the assessor on the bottom half of the form will have those components. And again, that Excel spreadsheet will walk through that TABOR calculation too. TABOR also, again, has a mill levy limit that says that the prior voter approval to increase the mill levy is required. So the question then is, which limit applies? If a local government is subject to the TABOR revenue limit, the TABOR mill levy limit, and the 5.5 revenue limit, which do you use? And there's case law and lots of local interpretation. and Attorney General opinions that all have really converged on the most restrictive being the one to use. And so here's an illustration. Let's say that we're doing the 2021 budget and a fictional local government has an assessed value of 15 million and their current mill levy is 8 mills, let's say. And then they calculate the 5.5 and the dollars they come up with the 5.5 is just shy of $110,000. So they back into a mill levy of 7.367 mills. And then their TABOR calculation, they back into 7.222 mills. So 8 mills, 7.367, 7.222. The TABOR revenue limit is the most restrictive for them for 2021 in this hypothetical. But if they go to 7.222 from 8, TABOR says you need voter approval to go back up. So this is commonly, you'll hear people talk about the ratchet down effect. If you go to, the common interpretation is that if you go to 7.222, you can't go back up to 8. And this is where it's a very common practice. Instead of permanently certifying 7.222, local governments will continue to certify 8, also certify a temporary tax credit or a temporary mill levy reduction to temporarily lower to 7.222. And this use of a temporary tax credit to preserve the 8 mills or whatever the mill levies is again very common. It's, to my knowledge, not been tested in court. So if you have concerns that we have been preserving this mill levy from the 90s, could we ever go back there? That's something you may want to talk to your attorney about, but just know it's a really common practice and probably the interpretation by attorneys as well. Your TABOR says you can affect a refund. You're really doing it in the same year. So that's the use of a temporary tax credit. Some other legal limits on the budget. TABOR also has a fiscal year spending limit that says that and defines fiscal year spending as all district expenditures and revenue increases, or what you spend and what you put in the bank, but does give exceptions. All kinds of sources TABOR excludes, gifts and donations, federal funds like federal grants, for example, sale of property, and some others. And then TABOR also, or the fiscal year spending limit in TABOR also allows an maximum annual fiscal year spending growth as the same inflation and local growth definitions that TABOR has for the property tax revenue limit. TABOR, another limit in TABOR is the debt limit that local governments need voter approval in advance for multi-year fiscal obligations. So that's most loans or bonds. TABOR also says this is a minimum. Most of the TABOR limits are kind of maximum limits, but TABOR's emergency reserve limit requires at minimum 3% of fiscal year spending for emergencies. Some other limits, the budget law says no deficit spending. The budget law also says that appropriations must equal expenditures and expenditures must equal appropriations. So those are some other limits on local government budgets. And then elections. The TABOR amendment says that voters can approve excess revenue in excess of the fiscal year spending limit, the property tax revenue limit, in excess of the debt limit or approval to increase debt, or for any tax increases or new taxes. A common sort of nickname for these kind of elections are debrucing, named after the TABOR author. The 5.5 also allows voters to approve, to allow a taxing entity to retain revenue in excess of the 5.5. For these elections, just notify us if you've had an election that waives the 5.5, and very commonly, one of those TABOR debrucing language ballot issues also has language sufficient and asks about the 5.5. So if you've had one of those, let DLG know and send us the ballot, a copy of the ballot and the certified election results, and we'll review it for a waiver from the 5.5. So in conclusion, with 10 minutes to spare, know and understand the limits on your budget and what limits maybe no longer apply, maybe because voters have removed them. And if voters have removed certain limits, they've probably placed other limits, or what conditions on those voter approvals apply, if any, and that would be in ballot language. And then how to manage underneath these limits.
Thank you for watching our presentation. We hope this format will benefit you in your work for ad valorem taxation. If you would like to provide any feedback or have any questions about the course, please contact the Colorado Division of Property Taxation.